Let me ask you something uncomfortable. How much money do you think you need to retire? 1 million? 2 million? Whatever number just popped into your head, where did it come from? Did you calculate it yourself, or did some financial advisor with a nice suit and a sales quota tell you that's the magic number? And here's the question that should terrify you. What if that number is designed to keep you working until you're too old to enjoy the life you postponed? I'm going to prove to you using math a middle schooler could verify that most Americans are chasing a retirement number that's either impossibly high or catastrophically wrong. And the people who told you that number are the same ones profiting from your confusion. This isn't a conspiracy theory, it's simple incentive analysis. Follow the money and you'll see why you've been given the wrong map for the wrong destination. Here's the brutal truth nobody in the financial industry wants you to hear. The retirement number you're chasing was never calculated for your life. It was calculated to sell you products, keep you dependent on advisors, and maximize the fees they extract from your anxiety. Warren and I have watched this game play out for decades. The same playbook, the same victims, the same predictable outcome. People work themselves into the ground, chasing a number they don't understand, based on assumptions they never questioned, following advice from people whose interests don't align with theirs. Let me show you the math they don't want you to see. The average American is told they need $1 to $2 million to retire comfortably. Sounds reasonable, right? Except when you actually run the numbers, it falls apart immediately. Let's say you spend $60,000 a year in retirement. That's not luxury. That's middle class in most of America. The standard advice says you need 25 times your annual spending. 25 times 60,000 is 1.5 million. Simple enough. But here's what they don't tell you. That calculation assumes a 4% withdrawal rate, which assumes historical stock market returns continue forever, which assumes you never face a major market crash in your first 5 years of retirement, which assumes healthcare costs don't explode, which assumes inflation stays tame, which assumes you die right on schedule. That's 6 massive assumptions stacked on top of each other, and if any one of them breaks, your plan collapses. This isn't a plan. This is a house of cards, with your future at stake. Warren has a saying I love: risk comes from not knowing what you're doing. Most people have no idea what assumptions are baked into their retirement plan because they never asked. They just trusted the expert in the nice office who showed them a colorful chart that goes up and to the right. But that expert gets paid whether your plan works or not. In fact, they get paid more if you keep working longer and contributing more. See the problem? The incentive structure is designed to benefit them, not you. Let me give you a different framework, one Warren and I actually use. We don't ask how much money we need. We ask what's the minimum we can live on comfortably, and what assets produce reliable income to cover that. Notice the inversion. We're not chasing a number. We're building a system that works regardless of what the market does. This is the difference between hoping you have enough and knowing you'll be fine. Here's the part that makes people uncomfortable. Most Americans are oversaving for retirement in the wrong vehicles while underinvesting in income-producing assets. They're stuffing money into 401k plans and IRAs, paying fees they don't understand, buying funds they can't explain, all because that's what everyone does. It's socially acceptable financial mediocrity. But when you're 75 and still working part-time because your portfolio got cut in half during a crash, being socially acceptable won't help you. Let me tell you what Warren does with his own money. Not what he tells the public to do, but what he actually does. He doesn't have a retirement number. He owns businesses that generate cash flow whether he works or not. Berkshire doesn't pay him a massive salary. It pays him dividends from businesses that produce products people need year after year after year. That's not a retirement plan. That's a permanent income stream that can't be crashed by a bad market or stolen by inflation. Now I know what you're thinking. Charlie, I can't buy entire businesses like Berkshire does. You're right, you can't. But you can own pieces of businesses through stocks. You can buy rental properties that generate monthly income. You can build skills that let you earn money even in retirement. You can create anything that produces value for others and gets paid for it. The point isn't to copy what Warren does. The point is to copy how he thinks. He thinks in terms of productive assets, not savings numbers. Here's where most retirement planning goes catastrophically wrong. It treats retirement as a finish line when it should be treated as a transition. The plan is work for 40 years, accumulate a pile of money, stop working, and pray the pile lasts until you die. But that's not how life works. You don't suddenly stop needing purpose, income, or mental stimulation the day you turn 65. In fact, the people who retire completely and do nothing tend to decline rapidly, both mentally and physically. The body and brain need work. Not soul-crushing corporate misery, but meaningful, productive activity. Warren is 94 years old and still goes to work every day. Not because he needs the money, obviously, but because he loves what he does, and it keeps him sharp. I'm 99 and doing the same thing. We didn't retire. We transitioned to doing only what we find interesting and valuable. That's the real retirement goal, having enough productive assets that you only work on what you want, when you want, with people you respect. The number becomes irrelevant when you've built a life you don't need to retire from. Let me hit you with some math that should wake you up. If you're 45 years old right now and you're planning to retire at 65, you have 20 years to prepare. 20 years sounds like a lot, but it's not. Let's say you currently have 200,000 saved. Not bad, you're ahead of most Americans. If you add nothing to it and it grows at 7% annually, in 20 years you'll have about 770,000. Still short of the mythical 1.5 million target. So now you need to figure out how much to save monthly to hit that number. The answer is about $2,000 per month for 20 years. Can you afford that? Maybe, maybe not. But here's the more important question. Even if you hit 1.5 million, will it actually be enough? We already established that number is based on assumptions that might not hold. So you're killing yourself to hit a target that might be wrong anyway. This is what I call optimizing for the wrong variable. You're focused so hard on the number that you forgot to ask if the number even makes sense. Now let me show you the inversion. Instead of asking how much you need to save, ask how little you need to live well. If you can live comfortably on $40,000 a year instead of $60,000, your target just dropped by $500,000. That's 10 years of your life back. 10 years you don't have to spend in a job you hate. 10 years of freedom you just created by asking a different question. This is what I mean by avoiding stupidity. The stupid move is chasing a bigger number. The smart move is needing a smaller number. But here's where it gets even better. If you can live on $40,000 a year and you build income streams that produce $40,000 a year, you never need to touch your principal. Your retirement account could be $100,000 or $1 million. It doesn't matter because you're living off the income, not the savings. This is how wealthy people actually retire. They don't spend down a pile of money until it runs out. They live off assets that keep producing forever. Warren doesn't have a spend-down plan. Berkshire generates billions in profit every year, and he takes what he needs and reinvests the rest. It's a perpetual income machine. You can build a smaller version of the same thing with rental properties, dividend stocks, royalties from creative work, online businesses, consulting income, anything that pays you for value you created once or continue to create at your own pace. The goal isn't a number in an account. The goal is a system that feeds you forever. Let me address the elephant in the room, Social Security. Everyone's worried it won't be there. Maybe it will, maybe it won't, but here's what I know for certain. If your entire retirement plan depends on a government program that's been insolvent for decades, you're not planning, you're hoping. Hope is not a strategy. It's a recipe for disappointment. Treat Social Security like a potential bonus, not your foundation. If it's there, great. If not, you're fine because you built something that doesn't depend on politicians keeping promises. Here's another uncomfortable truth. The retirement crisis in America isn't primarily about people not saving enough. It's about people saving in the wrong way, at the wrong time, for the wrong reasons. They're maxing out 401k plans that lock up their money until they're 60, paying fees that compound against them, buying target date funds that shift into bonds right when they need growth, all because that's what conventional wisdom says to do. But conventional wisdom is designed for average results, and average results in retirement means working until you're 70 and dying broke. Warren and I didn't get wealthy following conventional wisdom. We got wealthy by thinking clearly, avoiding stupidity, and letting compound interest do its work over many decades. The key phrase there is avoiding stupidity. We didn't need to be geniuses. We just needed to not be idiots consistently over a long period of time. The same principle applies to retirement. You don't need a brilliant plan. You need a plan that doesn't have stupid assumptions baked into it. So what are the stupid assumptions most retirement plans have? First, they assume steady returns with no major crashes near retirement. Wrong. Markets crash. They always have. They always will. If you retire in 2008, right as the market tanks, your 4% withdrawal rate just became an 8% withdrawal rate in real terms, and you're depleting your principal twice as fast. Second assumption, they assume healthcare costs stay manageable. Also wrong. Healthcare is the #1 cause of bankruptcy for retirees. One serious illness can wipe out decades of savings. Third assumption, they assume you'll want to stop working completely. For most people, also wrong. Retirement isn't about doing nothing. It's about doing what you want instead of what you have to. The people who retire and play golf every day often end up miserable and purposeless within a few years. The happiest retirees I know are the ones who transitioned into meaningful work they enjoy, not the ones who quit everything cold turkey. Fourth assumption, they assume inflation stays around 2 to 3%. Historically wrong. We've had periods of much higher inflation, and there's no guarantee we won't again. If inflation runs at 6% for a decade, your purchasing power gets cut in half. Your 1.5 million becomes 750,000 in real terms. Suddenly you're broke, and you can't go back to work because you're 78 and unemployable. Fifth assumption, and this is the big one, they assume the same strategy that worked for the last generation will work for yours. Completely wrong. Your parents could retire on a pension and Social Security. You can't. Your kids will need even more because automation is eliminating jobs and concentrating wealth at the top. The game has changed, but the playbook hasn't. Following outdated advice in a new environment is a guaranteed way to fail. Let me give you a framework Warren uses that most people never hear about. He calls it the circle of competence. You only invest in things you deeply understand. If you don't understand how a business makes money, you don't invest in it. If you don't understand real estate in your market, you don't buy rental properties. If you don't understand bonds and interest rates, you don't buy bonds just because your advisor said to. Stay inside your circle of competence, and your results will be far better than trying to do everything. Here's how this applies to retirement. If you understand your own spending, you can optimize it. If you understand local real estate, you can buy rentals. If you understand a particular industry, you can do consulting work. If you understand online business, you can build passive income streams. But if you don't understand stock picking, don't pick stocks. Buy an index fund and forget about it. The point is to build your retirement plan around what you actually know, not what some generic template says you should do. Now let me talk about the biggest psychological trap in retirement planning: loss aversion. People are so terrified of losing money that they make decisions that guarantee they'll end up poor. They keep everything in cash or bonds, earning nothing, watching inflation destroy them slowly, because they're afraid of a market crash that might or might not happen. This is insane. They're choosing guaranteed loss to avoid potential loss. It's like refusing to drive because you might get in an accident, so you walk everywhere and arrive too late for every opportunity in life. Warren and I have lived through multiple market crashes. 1973, 1987, 2000, 2008, 2020. Every single time people panicked and sold at the bottom. Every single time the people who stayed calm and held on to quality assets came out fine. In fact, they came out better than fine because they bought more when prices were low. The crashes didn't destroy them. Their own panic destroyed them. The market was just the trigger. Their psychology was the gun. If you're 45 or older, you probably have 15 to 25 years until traditional retirement age. That's enough time for at least one, maybe two significant market crashes. They're going to happen. You can count on it. The question isn't whether you'll face a crash. The question is whether you'll panic and ruin yourself or stay rational and come out ahead. This is the single biggest factor in retirement success, and it has nothing to do with how much you save. It's entirely about whether you can control your own fear. Here's a test for you. If the market dropped 40% tomorrow, what would you do? If your answer is sell everything and go to cash, you're already doomed. You'll lock in losses and miss the recovery. If your answer is hold steady or even buy more, you might be okay. But be honest with yourself. Most people think they'd hold steady, but when they actually see their account balance drop by $100,000, they panic. Knowing what you should do and actually doing it under pressure are two completely different things. This is why I keep saying the problem isn't the plan, it's you. Your own psychology, your biases, your inability to think long-term when you're emotional. The financial industry knows this. That's why they sell you products that promise safety and guarantee fees. They're not managing your money. They're managing your anxiety and charging you for the privilege. A good financial plan accounts for human psychology. It builds in safeguards so you can't panic your way into poverty. Warren has a great quote: "Be fearful when others are greedy, and greedy when others are fearful." Sounds simple, but almost nobody does it. When the market is crashing and everyone's terrified, that's when you should be buying. When the market is soaring and everyone's euphoric, that's when you should be cautious. But doing this requires you to act against your instincts, against social proof, against every emotional impulse you have. It's brutally hard, which is why so few people succeed at it. Let me give you a concrete example from our own experience. In 2008 and 2009, when the financial system was melting down and people were predicting the end of capitalism, Berkshire bought billions of dollars worth of stocks. We bought when everyone else was selling. Not because we're geniuses, but because we understood that good businesses selling at cheap prices are opportunities, not threats. Those investments made us many billions in the following decade. Meanwhile, the average investor who sold in panic and bought back years later after the recovery lost a fortune. The lesson isn't that you should try to time the market. You can't. Nobody can. The lesson is that you should have a plan that assumes crashes will happen, accounts for them, and doesn't require perfect timing to work. A plan that says, I'll hold quality assets through volatility. I'll keep some cash to buy opportunities. I'll never panic sell, and I'll rebalance when things get extreme. That's a plan that works in any market. That's a plan that survives your own psychology. Now here's the part where I lose half the audience, but it needs to be said. If you're 45 or older and you have less than $100,000 saved for retirement, you're not going to make it on savings alone. The math doesn't work. Even if you save aggressively for 20 years, you won't hit the traditional retirement number. This isn't meant to depress you. It's meant to wake you up to reality so you can make different choices. Your choices are pretty clear. Option 1, Lower your expenses dramatically so you need less in retirement. Stop trying to keep up with neighbors who are broke anyway. Downsize your life, cut the nonsense spending, and live well on much less. Option 2, plan to work longer, but transition into work you actually enjoy rather than corporate misery. Build skills that let you earn money on your terms past 65. Option 3, build income streams now that will pay you in retirement regardless of how much you have saved. Rental income, business income, royalty income, anything that keeps paying. Option 4, and this is the one nobody talks about, combine all three. Live on less, work longer at something meaningful, and build income streams. That's not a backup plan. For most Americans, that's the only plan that actually works. The mythical retire at 65 and do nothing for 30 years plan is dead. It only worked for one generation, and that generation is dying off. The new reality is you'll probably work in some capacity until you physically can't, so you'd better make sure it's work you don't hate. This sounds depressing, but it's actually liberating if you think about it right. If you're going to work anyway, why not build a life around work you find meaningful? Why not start now transitioning toward that instead of grinding away at a job you hate while fantasizing about a retirement that's never coming? Most people waste decades doing work they despise, waiting for a finish line that keeps moving further away. That's the real tragedy. Not that retirement looks different than expected, but that they postponed living until it was too late. Warren didn't wait until 65 to start doing what he loved. He started at 20. By the time most people are thinking about retirement, he'd already had 45 years of doing exactly what he wanted. That's the real advantage of building a life you don't need to retire from. You get to enjoy the journey instead of suffering through it while waiting for some magical future that might never arrive. Let me give you another inversion that clarifies everything. Instead of asking, how do I retire rich, ask, how do I avoid retiring poor? The answer to the second question is much clearer. Don't volunteer to lose purchasing power by holding cash. Don't panic sell during crashes. Don't pay high fees for underperformance. Don't follow conventional wisdom that's designed for someone else's circumstances. Don't assume the future will look like the past. Don't lie to yourself about your own behavior under stress. Avoiding stupidity is easier than achieving brilliance. But even avoiding stupidity requires discipline most people don't have. It requires you to think long-term when everyone around you is thinking short-term. It requires you to be honest about your own weaknesses and build systems that protect you from yourself. It requires you to ignore social proof and do what's rational instead of what's popular. These things are simple, but not easy. Simple means you understand them. Not easy means you won't do them without serious effort. Here's what I want you to understand. The retirement crisis in America isn't an accident. It's the predictable result of perverse incentives, broken assumptions, and human psychology colliding with mathematical reality. The financial industry makes money by keeping you confused and dependent. The government makes promises it can't keep to win votes. And you make emotional decisions based on fear and hope instead of rational analysis. The result is millions of people headed toward a retirement they can't afford, didn't plan for, and won't enjoy. But you don't have to be one of them. You can think clearly, plan rationally, act consistently, and build something that actually works. You won't get there by following the herd. You'll get there by questioning everything, understanding the math, knowing your own psychology, and making decisions based on reality instead of wishful thinking. It's not complicated, but it does require you to be honest with yourself in ways most people never are. Warren and I didn't build Berkshire Hathaway from a failing textile mill into one of the most valuable companies in the world by being lucky. We did it by being rational, patient, and consistent for 60 years. We avoided stupid mistakes. We let compound interest do its work. We didn't panic when things got hard. We didn't get greedy when things were easy. We just kept making sensible decisions day after day, year after year, decade after decade. You can do the same thing on a smaller scale. You won't build a company worth hundreds of billions, but you can build a retirement that doesn't depend on luck, government promises, or market timing. You can build income streams that keep paying regardless of what happens to your 401k. You can live well on less than you think you need. You can work on your own terms past traditional retirement age. You can avoid the trap of chasing numbers that were never right for you in the first place. The choice is yours. You can keep following conventional advice, hoping it works out, crossing your fingers that all the assumptions hold, and discovering at 70 that they didn't. Or you can start thinking differently right now. Start questioning the retirement number you were given. Start calculating what you actually need based on your life, not someone else's template. Start building income streams that don't depend on your age or ability to work 40 hours a week. Start living in a way you won't need to retire from. Time is the one asset you can't buy more of. If you're 45, you have maybe 20 good working years left before your energy and health start declining. 20 years to build something sustainable, or 20 years wasted chasing someone else's definition of retirement success. The math is clear. The psychology is predictable. The solution is obvious. The only question is whether you'll actually do something about it or keep hoping everything works out. I'm 99 years old. Warren is 94. We've seen this pattern repeat for decades. People ignore the math, follow bad advice, make emotional decisions, and end up broke in old age. It's not tragic because they lacked intelligence. It's tragic because they lacked rationality, discipline, and the courage to think for themselves. Don't be one of them. You're better than that. You're smarter than that. But being smart doesn't matter if you don't act on what you know. The retirement lie isn't that you need $2 million. The lie is that there's a magic number at all. The truth is, you need enough productive assets to support your lifestyle, enough skills to keep earning if needed, enough discipline to avoid panic, and enough honesty to know what you actually want from life. Those things can't be reduced to a single number. They require thought, planning, and continuous adjustment. They require you to be an adult instead of a child, waiting for someone else to fix your problems. So here's your homework, and I mean actually do this. Don't just nod and forget about it. First, calculate your real monthly expenses. Not what you think you spend, what you actually spend. Track every dollar for 3 months. You'll be shocked at how much disappears into nothing. Second, figure out how much passive income you currently have. Rental income, dividends, royalties, anything that pays you without active work. For most people, the answer is 0. That's your problem right there. Third, calculate the gap. How much do you need monthly minus how much you have monthly? That gap is your real retirement challenge, not some arbitrary $1 million number. Fourth, make a plan to close that gap through some combination of lower expenses, continued income, and income-producing assets. Fifth, and this is the most important, write down what you'd do if the market crashed 50% next year. Not what you think you should do, what you'd actually do. If you can't honestly say you'd hold steady or buy more, your plan is broken and you need to fix it now. That's it. 5 things. If you do them honestly, you'll know more about your retirement readiness than 99% of Americans. You'll also probably realize your current plan doesn't work, which is uncomfortable but necessary. Better to realize it now when you can do something about it than at 68 when it's too late. The truth might hurt, but lies will destroy you. Choose truth, choose rationality, choose thinking for yourself. That's the only retirement plan that actually works.